Bob. Bob is about to start his first day at his new job where he will be in charge of finance. Now, what exactly will Bob do at his new job? In his new role, he will likely face questions like, what long-term investments or projects should the company undertake? How should the company pay for these assets? Should they use equity or debt financing? And how much cash or inventory should the company carry? Bob will need to provide answers to these questions, balancing the risk involved with each initiative versus the return they can receive. Bob will need to build upon his understanding of economics and accounting to be successful in his new finance role. An understanding of economics will provide Bob with a broad picture of the economy and the key measures that influence the corporation's decisions and performance, like interest rates and taxes. It will also provide a structure for how to make decisions, including risk analysis, understanding supply and demand relationships, and comparative return analysis. An understanding of accounting will provide Bob with much of the language of finance, as well as the data that a financial manager will interpret and use in decision making. There are many functions that Bob will be responsible for in his new job. The daily activities of financial management require careful monitoring of the cash position of the firm and will consume most of his time. Less routine functions of a longer-term nature often require extensive analysis, as these decisions are often of strategic importance and may require large capital investment. Sounds like Bob's plate will be full in his new role. With so many things that will occupy his time, what do you think is the main goal for Bob working at the company? Bob was hired by the company's owners to make lots of decisions, but his primary purpose is to look after the interest of the owners. And the interest of the owners is to see that the value of the company that they own grows. In other words, Bob's job is to maximize the wealth of the owners. And to do that, he needs to focus on increasing the value of the company so the wealth of the individual shareholders increases as well. So how does Bob know if he's doing a good job? Should he look at profit? How about market share? Or perhaps he should look at the size of the company? Well, the best way to measure Bob's performance is to look at what other investors are willing to pay for a share in ownership of the company. In other words, Bob needs to pay attention to the market share price of the company. If a decision he makes maintains or increases the share price and the firm's overall value, it is a good decision because he is increasing the wealth of the shareholders. If it does not, then his course of action should be rejected. What do you think? Do you see any problems with Bob's primary goal of maximizing shareholder wealth? Do you think there could be a possibility for conflict between what the owners want and how Bob goes about making the day-to-day decisions for the company? If you said yes, you are correct. In fact, a branch of financial research called agency theory examines this potential for conflict between shareholders and managers. You see, Bob has his own interests to look after. He will want to maintain his job, protect his influence, and maximize how much money he makes. And pursuit of those interests may compromise growing shareholder wealth over the long term. The fact of the matter is, the goal of maximizing shareholder wealth can run into conflict on several fronts. Not only may it conflict with interests of management, it may not align with certain social and/or ethical goals. The good news is these conflicts can be addressed. Companies have successfully adopted policies that maximize their values in the market and align management decision-making with this goal, and offer benefits to the community and environment it works in. Recognizing that there may be different motivations, companies can introduce measures to monitor and hold managers accountable to that goal of shareholder wealth maximization that is also consistent with a concern for social responsibility. It is important to note that at the heart of such companies who achieve success in these areas are managers who operate ethically. So what does it mean for a manager to operate ethically? It means, among other things, that 1. They are fair. They obey the rules, maintain appropriate compensation for employees, and ensure all shareholders are accounted for. And 2. They are honest. They provide full disclosure of important company developments and maintain rigorous financial reporting. Bob will be successful in his new role as a financial manager if he chooses to uphold these values when conducting himself in his new role. Good luck to you, Bob.